Thank you very much, Jim Friedman, and good afternoon, ladies and gentlemen. It's indeed a pleasure and honor to be part of this very important gathering. And again, I wish I had an award to give to Jim Friedman for the Crystal Ball Award today for timing things out magnificently. Had a big day, of course. Been on the air all day talking about it. In case you hadn't heard, the Dow moved sharply lower. Ben Bernanke testified today. I'm sure you're all very, very well informed. And the biggest thing is even the tabloids are reporting about what's happening on Wall Street now. Fall Street, Jessica Simpson, Brittany taking a back seat to the business news, which is now the lead story today on the networks and, of course, right here. So we have a great panel to talk about all the latest developments. It's been a tumultuous day, certainly, with the Fed chairman's comments saying that he doesn't see a recession, but he does see economic growth moving lower this year and expects a turnaround by the end of the year. Of course, Wall Street, very skeptical of that claim. I don't know if you heard the KNX business hour today, but we had a roaring bear kicking off the show and then someone who was less bearish toward the end there. But tumultuous times and certainly the credit crunch and what we're about to discuss here are very much in the spotlight. Michael Perry, of course, who is the chairman and CEO of IndyMac Bank Corp., had some tough announcements this week in Pasadena with, I believe it was about 25% of the staff being reduced. And why don't we start with you, Michael, and give us your view of the situation since the mortgage business is so much in the forefront of what we've been seeing here.
Well, I mean, I think, you know, we have a credit cycle going on in financial services led by mortgages, but I think eventually you'll see problems in all of consumer credit, from mortgages to credit cards to auto loans, and I think you're going to see it, you know, step into the commercial real estate sector and some of the other commercial sectors. You know, we may not have a recession in our country because I think Main Street right now is still relatively strong, but we certainly have a serious recession, if not more, in financial services, and financial services is really the fuel for the economy. When you have two of the largest financial institutions in the country reporting this week, I think both of them, Citigroup and Merrill, both reported losses of almost $10 billion after tax in the fourth quarter. The biggest losses in their history. You know that we have something very serious going on, and what happens in financial services. I think I was reading somewhere that financial services was 25% of, I think it was the S&P 500 earnings last year in the fourth quarter. And this year, I think after those losses, the initial projection was financial services was going to be about 7% of S&P 500 earnings, and I think it's closer to 0. And the point being, the financial service industry is, with these losses, is very capital constrained. They're tightening credit. That's going to have an impact on Main Street economy.
Thank you very much, and we're going to go right down the line here, and of course we'll have plenty of time for your direct questions to the panelists as we wrap up this afternoon. Frederick T. Furlong is Group Vice President, Financial and Regional Executive Director, Center for the Study of Innovation and Productivity at the Federal Reserve Bank of San Francisco. What's your reaction to what we heard from the Fed Chairman today and where things are going from here?
Well, I thought you were going to ask me that. In terms of what the gist of what was going on, in terms of, I think, a lot of focus on, is there a recession, not a recession. I think an important thing, and it comes out in the chairman's comments, that may not get as much play. So, what is it that we're dealing with right now? And it's what makes up a financial crisis, and that is problems of valuation of assets, uncertainty about what the value of assets are and who's holding them. That's what kicked this off, and the intent, as that has intensified, started off with subprime, has intensified, and moved over to structured finances. And when that happened is of course, you have a shift in demand for liquidity, you have the pullback in the availability of credit. We saw these in many of the areas, securitization. Why do we have a credit crunch right now? It's because in the area of securitization that had been carrying a lot of the weight in terms of the financial tailwinds that were pushing the economy even through 2006. A lot of that has dried up. The burden has been pushed off onto the commercial banks. to absorb the lack of liquidity that we saw in leveraged buyouts, non-conforming mortgages. Those are being pulled back in. Commercial paper, banks have had to pick up some of that, as well as these structured vehicles that some of them are sponsoring and being back on their books. This has ballooned the balance sheets of the banks. So the banks now are constrained in terms of their assets as they're growing, but they also are part of being come under scrutiny because of this valuation. So what we see concerns about these declarations by Citigroup or Merrill in terms of losses, this concern about valuation and what position they're in are also going over to them. So part of what I think the chairman was talking about, what is the issue here in terms of valuation, and what is the Fed's response, and what does this mean? Well, what we've seen is that this valuation concerns have been going into the other part of the risk. That is, we move from valuation risk to the macroeconomic risk, and so we're seeing the hit on the economy more generally from the problems in the financial markets, and that's also enforced by the decline in values in homes that are impacting probably consumer decisions. So, in terms of where that puts us, are we in a recession, not a recession? Clearly, our view is that you've moved to a lower pace of growth in the economy. Anytime you have growth moving down to the into the below 2%, into the 1% range, you always can talk about the possibility of recessions rearing their heads. But there's a difference between predicting that there will be negative growth versus predicting low growth, and there will be some possibility that you could have some negative growth down the line.
The credit crisis is a global issue, and to talk about that some more now, Sebastian Edwards, the Henry Ford Chair in International Management here at the UCLA Anderson Graduate School of Management. Give us your global view of this credit crunch we're experiencing.
Thank you, Frank. It's a, it's a real pleasure to be here and to be able to talk about these issues. I will start with some remarks about the U.S. and then in the next rounds maybe I'll get to the global issues. There was an interesting comment a couple of days ago by Mike Levy, the chief economist of Bank of America, and he said it surely feels like a recession, it looks like a recession, it certainly hurts like a recession, and then he added, but it ain't a recession. And I think that he's playing with words like Humpty Dumpty in Alice Through the Looking Glass. If it hurts like a recession and looks like a recession and feels like a recession, well, I'm going to call it a recession. And I think that we either are in a recession already or are about to enter into one, and it's going to be painful, but it's going to be short-lived. I don't think that it's going to last for too long, nor do I think that it's going to affect the rest of the world. What I do think is that it's going to be very complicated for the Federal Reserve for a number of reasons. First, one that has not been mentioned by either Mike or Fred, and that is that inflationary pressures continue to be very, very high. We had the release of the CPI for the year yesterday, and it came out at 4.1% for the year 2007. Now, 4.1% may not sound very high, but it is very high. I want to remind you that when Nixon imposed price controls, good old solid Republican imposing price controls in the 1970s, that happened when the CPI rate of inflation got to 4%. So that's the level where we are, and that is certainly not acceptable for the Federal Reserve, nor for Congress, not for Barney Franks and for the Democrats that have the responsibility, according to the Constitution and to the 1913 Federal Reserve Act, to supervise the Federal Reserve. So that is one problem. The second problem, of course, is the financial crisis that Fred referred to. And there are two aspects to this financial crisis, and I will mention them, and then I will stop and let Ed to present his view. The first one, both of these financial crisis aspects were presented by Fred. One is that there is a problem with the valuation of assets, and there's a lot of uncertainty, and we don't know what, or we didn't know until recently, who held what and what were the prices of these different, quite sophisticated and exotic instruments. The second aspect of the financial crisis was also mentioned by Fred, is that banks have been hurt and their tier one regulatory capital has shrunk. and that results due to the multiplying effect that banks, of course, have a small capital and lend a large proportion, a large multiple of that capital. That has resulted, or has the potential of resulting in a credit crunch of unprecedented proportions, $1.5 to $2 trillion, unless they get capitalized. I think that on the confidence part, we have moved a long way towards solving it. In the last 30 days, the London interbank rate for 3 months operations has come down by 100 basis points. And today it stands, and that's today's, at 3.926, which is below the federal funds rate. And this is a remarkable reduction, a very quick one, and is a result of the decisive action by the Federal Reserve with the auctions and by the European Central Bank by the injection that Jean-Claude Trichet made on the 23rd of December of $500 billion into the European capital markets. So I think that on the confidence side, we've moved well. There's been very good reaction by these institutions. On the Tier 1 capital, we have a problem. As I said, this is shrinking. The recognition of losses by Merrill and by Citi in the last 2 days, it's very, very serious. They have to be recapitalized. They are being recapitalized. And here I just ask a question to the panel. They are being recapitalized by Abu Dhabi, the sovereign funds in Asia and in the Middle East. What does that represent for a country? How is Congress going to react? Are we going to have some protectionist reaction saying, hey, we cannot accept that our financial sector is now controlled by what it's basically going to be the Central Committee of the Communist Party in China? Question mark. Is that acceptable for us?
Very good question. Well, we'll get to that in just a moment. Dr. Ed Leamer, of course, a frequent guest on the KNX Business Hour, very famous on the show, and we do appreciate it. And of course, director of the Anderson Forecast here, Chauncey J. Medbury, chair in management. Dr. Leamer, let's get your perspective on the current situation, please.
No recession, but I have my
Humpty Dumpty.
I have my resignation all prepared. I'm going to spend more time with my family if there actually is a recession.
Wow.
But I understand you guys had a phone conversation in which you said no PowerPoints, but I can't talk without PowerPoints. So I prepared some of these slides, and I want to talk a little bit about them and give you my viewpoint about why there is not going to be a recession.
That's why we say the pictures are better on radio, so go right ahead.
Yeah. So I'll try to describe it so it works on radio here. But if you look at page 3, let's understand what we're talking about when we say what's a recession. You look at page 3, figure 3A.
Did you get those in?
I have some more. These students seem desperate to have this material, so.
You should starve the students.
Have an extra one.
Yeah, maybe.
So this figure 3A illustrates the unemployment rate in the United States. The recessions are determined officially by a committee of men, actually, at the National Bureau of Economic Research. And they pour over all the data, and they have a very complicated description of what they call a recession. You can tap into their website and figure that out. But I say if you have your 7-year-old daughter look at these mountains and valleys that is drawn by the unemployment rate, and have her color the slopes, the steep slopes facing westward, she would do the same thing that the NBR does. So what a recession is a sharp rise in unemployment. It's unwanted idleness. It's a pathology in the labor markets, the capital markets too. So idleness in the case of capital means factories and offices that are not operating at full capacity, not full. On the labor side, it's mostly unemployment. It's idleness is what the recession is. So when I say no recession, I mean we're not going to have a sharp rise in idleness that would be similar to the recessions that we've had in the past. But if you look at our forecast at the right, we know the economy is going to be sluggish. We know that housing is going to be a big problem on the economy, and that sluggishness inevitably gives rise to some rise in unemployment. So maybe it's Humpty Dumpty, but there's a difference between a small rise to, say, 5.25% versus the 6% inflation or 6% unemployment that is being called for by Goldman and Merrill Lynch and a couple of other Wall Street firms that are predicting a recession. We don't think we're going to get enough job loss to actually have that outcome occur. So what about housing? 3B tells you is a table that illustrates all the housing corrections that we've had since World War II. And row number one, in row number one, you see the peak was in 1973, quarter one, and the trough was in 1975, quarter one. And during that period of time, problems in housing pulled a full 2.33 out of GDP growth. Remember, normal GDP growth is 3% per year. So this is a 2-year period in time in which housing subtracted 2.33. That lasted 8 quarters. The decline or the subtraction per year was 1.16. And was there a recession? Yes. That time there was a recession. What was the lag between the housing downturn and the economy downturn? 3 quarters. That was our worst event, the 1973 problem. Then in 1950, we had a very severe housing problem, the number 2 problem, but we didn't have a recession. And why was that? And there's not too many people in the room who remember, but 1951 was the beginning of the Korean War. And the Department of Defense ramped up spending enormously at that time, enormously. You can hardly believe it. DOD spending went up to 14% of GDP. So now it's like 2%. So it's just an enormous increase. So weakness in housing, the DOD came to the rescue and we didn't have a downturn. The number 3 downturn was a significant one. Where we are now is number 4 in terms of total damage that's already been done. Now, but if you look over to the right, we have not yet had a recession. And we're already 7 quarters into this thing now. So that recession, if you'd use these models, the housing type models, to predict a recession, you would have said the first quarter of 2007 would be the time that recession was most likely. This recession, based on housing, is way overdue. Something's different this time. The housing as a signal of a recession is not the same as it has been historically. Even though it's very severe, something different is occurring this time. And there are several things that are different, but I just want to bring to your attention the labor market, which is on page 5. The economy, so a recession is about job loss. So intellectually, the way I developed this story is I first said housing is telling us for sure we're going to have a recession. Either you have a big ramp up by the DOD on the war on terror, or you're going to have a housing-led recession. And then I started looking, well, what kind of recession is there going to be? Where's the job loss going to occur? So the job loss in recession is primarily in 2 sectors, which are manufacturing and construction. The rest of the economy has softness in job formation, but not actual job losses. So if we're going to tell a story about a recession coming anytime soon, it has to be a story about job loss in those 2 critical sectors, construction and manufacturing. 5A shows you what's happening around the cycle. The recession quarters or months are to the left of that vertical line. This is construction. The recession months are to the left of the vertical line, and to the right is the recovery and expansion. And you can see a kind of U-shape. The construction in all these cycles is sloughing off about 500,000 jobs. The by B is the same picture for all the payroll jobs in the United States except for construction and manufacturing. And you can see it's just growth, growth, growth. There's no dip, there's no V, there's no U, there's no significant decline in any of these downturns outside of those critical sectors. Now, for example, we're going to have problems, and we are having problems in finance, particularly real estate-related finance. But you add up all these sectors together, the weakness in some are offset by strength in others traditionally. So the big ones to worry about are construction and manufacturing. Construction definitely is positioned to slough off jobs and is sloughing off jobs. But 500,000 job loss is not enough to call a real recession. You're going to have a contribution from manufacturing. And the 6A tells us the story in manufacturing. And here you see the label V. That's happening. That shows you what's happening to jobs in manufacturing around all these 10 historical recessions. It's been V, V, V. V meaning you trim and you fatten. Very quickly, you fatten up again. You have weakness in sales, you trim very significantly, and then within a couple more quarters, you fatten it up again. It's V, 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 over and over and over throughout these 10 recessions. The 1990 was a U, in which we sloughed off jobs pretty slowly, and then we brought them back pretty slowly. The latest one was an L, meaning that we lost 3 million jobs in manufacturing in 2001 and 2002, and there's been no fattening up. In fact, there's been a continuing, very gradual decay in jobs in manufacturing. And it just doesn't seem, with manufacturing a much smaller fraction of the workforce, and having not fattened up, it doesn't seem like manufacturing is going to contribute enough job loss for it to be a real recession. So now if you want to know some indicators to look at, one indicator that will tell you that I'm wrong is weekly hours in manufacturing, because firms don't lay off. In the face of weakened demand, they don't lay off initially workers. They cut down overtime, and they slow down the pace of operations. A symptom of that is weekly hours in manufacturing. So if you see a significant decline in that indicator, that's going to be an unraveling my viewpoint. But it's strong, it's not weak. There's no evidence that weekly hours are declining in manufacturing. And then secondly, in figure 7B, if you want to know whether you're in the recession, watch initial claims for unemployment. So these are people who are losing jobs. In a recession, jobs are easy to lose and hard to find. I think we're in a period in which jobs are going to be hard to find, but they're not going to be easy to lose. We're not going to lose a lot of jobs. We're not going to call it an official recession without job loss. So watch initial claims in unemployment, initial claims for unemployment. And that looked very worrisome in November. It started to peak up. You can see that these claims for, initial claims for unemployment go up and down. When the economy is healthy, they're about 300,000 per month. That's a lot of layoffs, but those people pretty quickly find another job elsewhere. That's the strength of the economy. A lot of turnover. 300,000 a month. But in a recession, that thing jumps up to 450,000 per month. It always has. Well, this thing started to elevate to 340 and started looking like I was wrong. I was getting very nervous. But over the last month, it's turned around. And the latest number was 310, which is a very strong number, a symptom of a healthy job market in the sense that there are very few layoffs. So my view is, looking backward, we're most likely to come to the conclusion that November and December were the weakest months in the U.S. economy, and that we're going to get beyond this housing crunch. We're not going to have a correction of total, housing isn't going to be healthy again. IndyMac isn't going to be back to where it was in terms of its valuations for a few months later than that. We're not calling for housing to completely get healthy, but the drag that declining building has had on the economy is going to be behind us within the next couple of quarters, by mid-year. From then on, the U.S. economy is going to struggle along. Now, the wealth effect is still there. Our other panelists mentioned this. I'm going to stop here because I'm taking up all the time. But the wealth effect is definitely there, meaning that we're not as wealthy as we think we are, or as we thought we are. We've got about $5 trillion worth of inappropriate valuations in U.S. real estate. And we, businesses and lenders, and particularly American consumers, have to realize that that isn't real wealth. That's just paper wealth. And we're going to have to cut back. But that cutback is not going to cause recession, because you're going to do your belt tightening tomorrow, but I'm going to wait for a year from now, and Sebastian's going to wait 3 or 4 years from now. If that gets, all the belt tightening is done at different points of time, you don't get a recession, you get a weak economy. And that's what we think is most likely to occur over the next couple of years. Belt tightening by consumers because of the wealth effect on housing, and the realization that as a country we're not saving nearly enough. We're an aging economy, we have huge liabilities for Social Security and Medicare, and we have personal liabilities to take care of ourselves when we get old. We're not saving nearly enough. The U.S. is going to have its savings rates rise slowly, sluggish economy. Now is a great time to buy equities.
Dr. Leamer, thank you very much for the smoothest PowerPoint presentation ever presented anywhere. Thank you very much for that.
The longest 5 minutes in the history of America.
Sorry, I'm done now.
Very fine, very fine. Now, let me just pass along some news here. It was about a week ago that the chief economist at Merrill Lynch announced the recession in the U.S. has arrived. Of course, today, Merrill Lynch announcing the biggest quarterly loss in the company's history, almost $15 billion of write-downs and bad subprime mortgage bets. Former Fed Chairman Alan Greenspan has chimed in this week on the recession story. The symptoms are clearly here. Greenspan, speaking Green Spanish, said recessions don't happen smoothly. They are usually signaled by a discontinuity in the marketplace, and the data of recent weeks could very well be characterized in that matter. Dr. Martin Feldstein was on the KNX Business Hour. He predicted a greater than 50% chance of a recession at this point. The economy, he says, being hit several ways simultaneously. It's not just housing, not just capital markets, not a fall in consumer wealth. All three could become quite serious. Dr. Arthur Laffer says the Fed has some responsibility in causing the problem. The last thing he says, we need uncertainty in an uncertain market. And Dr. Schiller, of course, from the Case-Shiller Index, says we've never seen declines like this in the housing market, so quite a few storm clouds. On the other hand, we're hearing from other economists, including the Fed chairman himself, who does not see a recession this year, but simply a downturn in growth. Now, Professor Edwards, what's this about we're going to have to get our mortgages from the Communist Central Committee in the future? Why don't you expand on that point and tell us, again, from the global standpoint, how this credit crunch can be resolved?
Yeah, let me do two things, if I may, Frank. First, go back to what Ed Leamer was saying, which I think was very interesting. And he showed us that our loss in construction now is the fourth in terms of a ranking. But I think that what Ed's story is telling us, if you go back to his slide 3B on page 3, is that construction is not the whole story. The first incidents there, 73, 75, it was a construction contraction plus the first oil shock. So you need the plus, we got a recession. The second one is 50, 51. It was a very severe contraction in the construction sector, and as Ed said, the Korea War started, so we had a positive offsetting factor coming from government expenditure, and there was no recession. The third one, which is 78, 80, important contraction in the construction and real estate sector with a recession. The compounding factor there, of course, was the second oil shock. And now we had the fourth one, which is 05, 07, that Ed was referring to, the current one, an important contraction in the real estate and construction sector with no recession so far. And the reason for that is that the additional shock was missing. And it now arrived in August, 10th of August of last year, and then it was exacerbated on the 21st of December of last year, and that is the credit crunch. And that credit event is a very significant credit event that adds the second factor that will result in a recession. And the question mark then is who is going to be the next director of the forecast?
That would be you. That would be you.
After Professor Leamer has to resign. Now, but we will forgive him, and we will reappoint him.
Say nothing more of it.
The problem, Frank, is that, as you pointed out, the most important, or many of the most important financial institutions in the U.S. Have had to recapitalize and have gone out to the international capital markets. And it turns out that today, for a number of reasons, including the fact that for a large number of years we have been running very, very significant trade deficits. Those that have deep pockets are in the surplus countries, in the trade and external surplus countries. And those surplus countries are the oil-exporting Middle Eastern countries, the Saudis and the United Arab Emirates, Abu Dhabi, Dubai, and the other 5 Emirates. And the Asian countries, in particular China, that holds 1.2, 1.3, we think, because we don't know exactly the numbers, $1 trillion in international reserves. These are sovereign funds, and the other one that, of course, is also run by a government is the Singaporean sovereign fund. We don't know how much money it has, but we think it's between $300 and $400 billion. And what is going on, of course, is that these funds are those that have been recapitalizing the banks. I hate the word bailout. They are not being bailed out. The shareholders are seeing their equities being diluted. The executives, many of them have been fired, and those that haven't been fired will be fired, many of them. They will not see bonuses. So bailout, it isn't. These are within the rules of capitalism. They are injecting capital into these institutions. But the problem is that those that are injecting capitals are sovereign funds, and they are sovereign funds from governments that are not exactly democracies. And if we go down the list, probably of all of those involved, the most democratic ones, or the ones that I've mentioned, is the Republic of Singapore, which, although it does have democratic system, it's pretty authoritarian. But if you go to Saudi Arabia and the Emirates, and China in particular, there is a potential political problem. And I can see the protectionist forces in Congress, Senator Schumer, for instance, and some of his colleagues, coming out and saying this is not acceptable, or putting some kind of conditions, or saying we need to make sure that the banks stay in U.S. hands. Now, that is the bad news, and we don't know how this is going to play out. Now, the good news, if there is any good news, is that the trade deficit has been shrinking, and that it has turned the corner, and that it is continued to shrink, and probably the dollar is about as weak as it will get with respect to the balance, the basket of currencies that we measure it, which is 26 currencies. There may be some additional weakness with respect to specific currencies, but I don't think that there will be a significant depreciation of the dollar going forward. But I think, and I don't have an answer to this, Frank, because it's really within the political realm, how is Congress in particular going to react to the fact that a non-trivial proportion of the capital of some of the most important financial institutions in this country are going to be owned by the governments, by the states, by foreign states. And these are foreign states that, as I said, are not democratic.
Mr. Perry, let's get back to the mortgage business for just a moment. How will that impact you, what the professor was just talking about, given the influx of foreign cash, and are you cheering this development?
Well, I mean, I think they needed to do it. You know, you look at the capital ratios of those large institutions, and clearly they're, unlike IndyMac, the institution that I run, they're too big to fail, right? They're institutions that are icons here in the United States, and you look at the capital levels that Citigroup has. I think even after the transaction, their core tangible ratio is something like 4%. So, you know, they run at a relatively low capital level. They're very large, highly rated institutions. You don't want to have this process, which is really going on out there in the marketplace right now, of the rating agencies downgrading our largest financial institutions and really creating a crisis of confidence. And so they needed to raise money quickly. They needed to raise it in large sums. And I think investors in the United States right now have lost confidence in the financial markets and in, because of these losses. And so that's why they've had to seek the funds overseas, and they've had relationships because these are worldwide financial institutions. So, I mean, I think it's positive they got the capital. You know, I do, you know, outside of being a banker, I would say you do have some concerns about having, I particularly am probably not a free trade advocate with countries that are not democracies. And clearly those institutions are going to have significant influence on some of our major financial institutions. But I think it's positive for the financial sector right now. I think ultimately they'll probably sell their positions down as time goes on. So I don't see it as, you know, some big influence on the country. I was joking at IndyMac, you know, we got the, we're going to be recapitalized by the El Monte School District. You know, I mean, we just don't have, you know, the kind of name brand for some foreign government to come and write us a check. So what we're having to do instead is eliminate our dividend and shrink our balance sheet over the next year, which is obviously not going to serve the housing market very well or the economy very well, you know, when all the smaller institutions who are not going to get that sovereign investment, they're not having anybody invest in them. And right now, frankly, we don't really want to have anybody invest in us because trading at such a discount to book value, if we got additional capital in, we'd be heavily diluting our shareholders. So, you know, my line is, you know, we're in a lifeboat. We've got the provisions that we are going to have through this crisis period. We came into it with a lot of provisions in terms of capital, probably almost double the capital levels of Citigroup. We're going to give some of that capital back in building loan loss reserves. And we're going to kind of fight our way through this crisis period in our core business, which is housing. That's really all IndyMac does, is home mortgage lending across the country. And you know that marketplace is really tough right now, home mortgage lending.
We did get a piece of good news today from mortgage giant Freddie Mac. I think mortgage rates are what at their lowest we've seen in a couple of years. but that doesn't seem to be igniting the market.
Well, I mean, I think it's a dichotomy. We're having very low mortgage rates for conforming mortgage loans, for Fannie and Freddie, FHA and VA loans, okay? But the jumbo market, just the plain vanilla jumbo home loan market, which is a huge part of California, right? There are not a lot of Fannie, Freddie, FHA, VA loans in a lot of parts of California. That market, there is no secondary market right now. It used to be, and that market's been around forever. It used to be I could take a pool of $100 billion of jumbo home loans, plain vanilla, good quality California jumbo home loans, and get the rating agencies to rate 94% of the bonds that were created from that pool as AAA bonds, and the rest were AA all the way down to unrated, so 6%. So they've increased that rating by about a third, about 8% now. But the markets have so little confidence in the rating agencies that there are virtually no investors who are willing to buy the AAA bond with that 8% subordination. In fact, one of the few buyers of the AAA bond today are the federal home loan banks, and they're going, we'll buy, Mike, but instead of 8% subordination to AAA, we want 30 or 40. Well, that makes the price for a jumbo home loan in the secondary market is almost a high-cost mortgage. So jumbo mortgages are being portfolioed by major financial institutions right now, but they don't really have the capital to portfolio the whole jumbo market. It's just such a massive market. And we've talked, recently the Democratic politicians have talked about infusing some money in the economy, like $100 billion or $50 billion, and writing checks to people. And there was an article in Newsweek this week, and Ed and I were talking about it was lollipop economics. That doesn't do a whole lot on our, $15 to $17 trillion economy. You put that $100 billion, our sovereign government put that money into our financial institutions in the form of equity capital, and we can turn around and lever that out and get this jumbo home loan market going, which is really important, I think, to get housing turned around. I think California should do that. I think CalPERS should be investing in financial institutions here in California like IndyMac so that we can get that jumbo market moving.
And indeed, lowering interest rates, it's believed, is not going to be the medicine this time around, given, again, the various factors we've been talking about, and, of course, the inflation concerns. Mr. Furlong, what's your view of what's going to happen at the end of the month here with interest rates, and what kind of medicine you think will be required? Something the Fed chairman talked about today, along with the president. We're expecting to get an announcement perhaps by the end of the week on some sort of a stimulus package. Give us your view of what it's going to take here to turn things around along with lower rates.
Okay, well, what the chairman said was that the Fed was looked at what's going on in the economy, and as we've gone through this process, going back to beginning of even last year, what we've seen is that as the situation moving and as the problems grew, more concern we had about the economy. And I think the talking about the early August 9th and 10th, when the real credit crisis did rear its head and really showed up in the money markets. Since then there's been a reassessment of the risk from the credit side. And I think, again, when we in December with the news on the economy, we've gotten another indication. Well, maybe we are seeing some weakness that we may not have otherwise expected. There was always seen as the risk and a downside. And I think that what is happening is seeing that risk becoming more obvious. And so what the Fed chairman has said, what Ben Bernanke has said, is that the Fed is prepared to act aggressively when as appropriate to offset some of these effects. So you're not going to offset. So we have these valuation issues. So you can't change the uncertainty about valuations and these sort of things, but you can change the impact it will have carrying through the rest of the economy. And that's what lowering interest rates, that's done already. So we've already had 100 basis points decrease in interest rates since September. No one in the Fed is ever going to tell you that, yeah, next meeting this is going to happen. Even Ben Bernanke didn't say that. Ben Bernanke said that the Fed would be ready to move aggressively, and that's as close as you're going to get to a prediction of what's going to happen at the next meeting. But the idea, though, is that you have these issues with regard to the financial crisis, which have to work themselves out. But what you don't want is those exacerbating the problems with feeding off through the economy itself. So you're providing the stimulus through the 100 basis points already. The market is expecting more cuts. So one thing you can say is you look at the market is expecting more cuts. Currently, the betting is on a 50 or a 75 basis point cut at the next meeting. We'll have to see what comes. But the idea is that the lower rates will allow to forestall these effects that might otherwise shift over to the economy. Because what that will mean, and we already see this built into the mortgage rates. Mortgage rates, although they haven't come down as much as the Treasury rates, mortgage rates are down for the conforming. We've even seen some progress even on the jumbo side. And we know that if you look at what's happening to the cost of funding for prime borrowers that we just talked about, those are down. What about investment-grade businesses? Their borrowing costs are down. So borrowing costs are coming down. So these actions, even though there's more risk and more uncertainty, the actual funding costs that many, many households and businesses are facing are actually declining. So while we see a tightening of credit standards, conditions, obviously for subprime and for riskier businesses, these rate cuts have provided even sort of an easing of credit conditions for a large set of other borrowers. The question is, of course, on the supply side, do you have the capitalization in the banking system to continue to provide the credit as we move forward? So far, we've seen the answer. So far, they haven't been able to raise that. And I will say one thing about these capital ratios that we talked about. That I should put in here. We've seen some decline in the capital ratios. We have some examples like Citigroup. They've actually had losses. For most of the banking organizations, the declines in their capital ratios have come because they've added so many assets to their balance sheets over the last 2 quarters. And so it's been the growth that they've had to absorb that's really been pushing them. But in terms of the outlook for the economy and the role of interest rates, that's what the interest rates are supposed to do, is try to move from having this valuation problem turn into a macroeconomic problem more than it has. So you can't necessarily change the valuation problem. That's a price discovery process that the market has to go through. But while that's going on, you can provide an environment, a financial environment, where there is lower cost of funds and some stimulus for a number of people, the prime borrowers and the higher rated corporations in the economy.
The concern has already been expressed today that we look like we're on a path that we might make the inflation situation worse if rates are cut now and then the stimulus package piles on. Professor Edwards, what are your thoughts about that possibility?
No, I think that the Fed is really facing a very difficult situation. I was not going to have a PowerPoint presentation either, but I want to be like Ed Leamer when I grow up. So he had a PowerPoint presentation. I also had one, which I think you have. And on page 8, I have inflation and then some other data that I want to refer you to of my handout. There's been, I think that there are 2 problems. First is that the Fed will not be able to be that aggressive, and I will explain why. And 2 is that the financial system has become so complex that the type of instruments that the Fed is using really are not that effective under these circumstances. And it has become much more difficult to really run monetary policy than just moving one little interest rate like the federal funds rate. So my slide on page 8 shows that inflation is 4.1% for 2007. And the bottom slide on page 9 shows, as Fred was saying, that the market expects, these are the implied probabilities of federal funds rate at the end of the January meeting of the Fed, that these are going to be either 3.5 or 3.75, so a cutoff between 50 and 75 basis points. The problem that I have with that is that if that happens, which I think will have 50 basis points, the real inflation-adjusted interest rate will become negative. 4.1 inflation, 4.1 inflation, and the federal funds rate will be 3.75 or 3.50. So the federal funds rate will be lower than the rate of inflation. Let me give you a little background here. The Fed, in the last 15 years, since they have pre-announced or scheduled meetings, has had 6 unscheduled meetings. Of those 6 unscheduled meetings, it has reduced interest rates on 3 of them, all 3 occasions in 2001. One of those was after 9/11, so that is a national emergency, it's not monetary policy. That leaves 2 unscheduled interest rate cuts that the Fed undertook in the year 2001. The first one was on January 3rd, 2001, just before the end of January regular meeting, and they cut interest rates in an unscheduled meeting by 50 basis points. The second one was on April 18, also of the year 2001, and they cut by another 50 basis points. This has made some people think it's going to happen again. We're going to see aggressive, they're interpreting that when Ben Bernanke says aggressive action, it's going to be, even during unscheduled meetings, these are usually conference calls, they're going to cut interest rates. Now, let me tell you the difference between 01 and now. In 01, the interest rate, the federal funds rate, when they cut by 50 basis points, was 6.5. So they lowered it to 6 with a rate of inflation of 3%. So the real rate of inflation continued to be 3%. And when they lowered it in April from 5 to 4.5, the rate of inflation was 2.7%. It was real positive interest rates. What happens now is that our rate of interest is already very low. 4.25 is below the average for federal funds rate for the last 55 years. So if we were to lower it by 100 basis points, it would be negative in real terms given our current rate of inflation. Last time we had negative real interest rates for a prolonged period of time was during the Carter inflation. And that, you know how it ended. It ended with Paul Volcker having to hike up interest rates to 18% in order to tame that monster that was created, which was runaway inflation. And I think that the good people at the Fed understand this and really face this tremendous dilemma. And that's why today, Ben Bernanke in Congress said something that many people are scratching their heads to understand. Ben Bernanke said, I favor a $150 billion stimulus package, much larger than what anyone was talking about. What is he doing? He's passing the ball or the bucket to the fiscal side of the equation. He wants the federal government, through fiscal policy, to do the job of encouraging the economy and making sure that the recession does not get, it doesn't happen or doesn't get too ugly, while he is able to maintain interest rates as a tool to fight inflation. We don't want to get the interest rate negative, in significantly negative. A little negative, it's okay, but significantly negative for a long period of time, because we know that what that will lead to, or we suspect, in particular in conditions like the current ones where there are inflationary pressures in China, in Europe, and all over the world. So I think the situation is it's quite complex and it's intellectually very interesting, but we're living dangerous times.
Dr. Leamer, do you want to respond to that?
Yeah, I totally disagree with all that Sebastian said. No, the question that lies behind this conversation that we're having is, when is housing going to be normal again? And in order to get housing normal, you have to bring buyers in there. And buyers are not going to buy homes while prices are declining and are expected to continue to decline. We have to have some price increase. And interest rates, lower interest rates are not going to bring buyers back into the market. Not in a context in which you've got this highly leveraged investment whose value, the asset value, is deteriorating. The odd thing is, this thing got started. I'm not sure Fred was involved in it, but the members of the Federal Reserve Open Market Committee stayed up late one night in 2001. They turned on the science fiction channel, and they watched how Godzilla and deflation destroyed the island of Japan. So they decided that they were going to do everything they could possibly do to keep these twin evils from the United States, and they just went nuts and lowered those interest rates enormously. And they did that because they thought that we were going to have a deflation problem. They thought the deflation problem was an overall general decline in prices which would make interest rates policy ineffective. What they didn't know is not prices in general, it's asset prices. When you have declining asset prices, you can't stimulate that sector, in the home building sector with declining asset prices, you can't stimulate it with lower rates. So the Fed, desperate to prevent a deflation problem, actually created the darn problem that they were trying to prevent. And the reason I think that Bernanke went to the fiscal policy is let's hope anyway, because Greenspan didn't demonstrate much intelligence, but Bernanke, let's hope he understood that monetary policy is totally ineffective today because you can't help the housing sector. And as far as the spillover to the rest of the economy, I know that there's rising defaults and delinquencies on consumer loans, but there isn't a credit crunch. You don't see the problems on Wall Street hitting Main Street big time yet. Maybe next year, I don't think so. So I don't think that the credit crunch another sure sign that we're not going to have a recession is when all the Wall Street economists say you're going to have a recession, and Alan Greenspan and Sebastian Edwards agree. Right? So bottom line is the housing sector is not going to be normal again. What the builders need to do, by the way, there's basically been two aggressive price setters in the marketplace, the banks through foreclosures and the builders. Builders need to stop cutting prices because that, rather than increasing demand, that lowers demand. I mean, normal for something that's not an asset, cutting price is a good thing. But it just encourages buyers to imagine you're going to get a better deal later on. So builders have cut very aggressively. They're starting to move their product. They need to turn this thing around and start raising prices. Then we'll get the housing market back to normal. We don't think that's going to occur very rapidly, maybe 2008 and 2009. But the problems in housing and the financial problems in housing are going to stay in housing this time. We're not going to have a recession.
Mr. Rowling, would you like to respond to that? Is Ben Bernanke willing to do anything to keep the economy going and risk the dollar and inflation?
So I think that it's clear, and whenever he's talking about the issue with regard to the economy, one thing he always mentions is the issue of inflation expectations being well anchored at this point still. And that's been something that you almost hear every time a Fed official will be talking. We're looking at not only where the economy is going, but also what you're concerned about inflation. And so at this point, I think if you see, and what are they looking at? So it's the break-even yield. So if you go to the TIPS market, so we know we have these inflation-protected TIPS, and you look at essentially the difference between those, you get an idea of what market expectations are in inflation. That's something the Fed has been keeping an eye on for some time. And those, while they vary quite a bit, if you look at them over the last, since this crisis broke in August, they've moved around, but they've been relatively stable. So what Ben Bernanke and others will say is, we're doing this, and at this point, we still see inflation expectations as being anchored, which means that, one, they don't, that the market is saying, well, even if we do have what look like negative real short rates, we don't think the Fed's going to stay there. We think the Fed is committed to price stability in the long run, so that the future policy is a prediction about what happens to future policy. So I think the answer is that you still have both the dual mandate in terms of full employment and price stability, and that price stability will play a role. And if we see issues with regard to inflation moving into affecting expectations, I think you'll see some different conversations and weighing of issues. One question I do have for Ed, and that has to do with the housing prices. I guess, are housing prices just? Isn't there some fundamental that the market is like? Isn't there like a price of any other good? And there's some price that this thing's going to sell at, and there's some clearing price. And it looks like we may or may not be there. But for a long time, people thought that housing was overpriced, and you looked at it relative to rent. Price-rent ratios were real high. That maybe that made sense when house appreciation was going up, because. So is that point. And the other point in terms of interest rates don't make any difference. Well, it's in a declining, if you have expected depreciation, we know that affects the user cost of capital, right? So interest rates are only one part of interest cost of capital. And so if you have house prices appreciating, then you're willing to pay have a higher price of that. But if they're depreciating, that raises your cost of capital. And so even if you have lower interest rates, if you have depreciating asset value, that's part of your cost of capital. So it's not that interest rates don't make any difference, it's just you have something else offsetting it, right?
But
So-
when house prices are declining at 10%, there's no interest rate that's going to get people.
No, that's what I'm
interested
saying,
in
but
those
it's not that
homes.
interest rates don't matter. It's like it's that you just have something offsetting. But what about the issue on house prices?
So
I mean,
the-
is there some clearing price, or is it you can just say, well, we'll just stop raising prices, declining prices, and that'll fix the
Well,
situation?
I like to say, when it comes to housing, it's a volume cycle, not a price cycle, meaning that you get a very dramatic reduction in volume. We had that in the early 90s in Los Angeles and much of Southern California, which volume was down by 50% in a year and a half. But prices move ever so slowly, and it's not the kind of market that you're talking about. It doesn't. We're going to mark to market, but it's going to take us 6, 7, or 8 years because the current owners have no urgency with regard to sell. They can hold on and hold on. They think that their idiot neighbor got $2 million for his home, and they're not going to take a penny less, and they can hold on. And
Except
hold on,
except
hold
for
on.
home builders who
Home
have to sell
builders and
because
the-
their bank lines are being,
Yeah.
they have to get inventory sold off their bank lines. And banks like IndyMac who have now high non-performing assets, and we have to get our non-performing asset ratios down. And those are going to be high levels of sales, listings and sales in various markets around the country. And I think one of the other conferences I was saying, this is a little bit of a dichotomy here where you don't have, and we have almost no foreclosures in most of what I would call the yuppie communities around America. We have foreclosures here in California in all the kind of places where the economies are a little tougher, or they're fringe communities. They're in Palmdale, Victorville, Fresno, my hometown of Sacramento. Places like that are where we're having foreclosures. None in Pasadena, Santa Monica, Newport Beach, Palo Alto. And that's the same across the country. I have scores of REO under $200,000. I have almost no foreclosures above $1 million, not one. Very few above $500,000. So this is the middle class or lower struggling, really struggling. Maybe some of them stretch too far. Some of them have become subprime borrowers because of the economies in certain states. Like, we have lots of REO in Michigan and Ohio and places like that. I do think interest rates are going to come down. I think, Bernanke said today, I don't care what's going on in the world, we're going down. The CPI is high because of energy. Energy is baked into food and a lot of other things. And the real CPI, if you take energy out, is much lower. They're going to cut interest rates. I think they're going to cut them significantly this year. I think he understands the financial crisis that's out there. It's going to help with these adjustable mortgages that are resetting. It's also going to help with risk. You drive interest rates down, and then it forces investors to take risk on. And investors in the U.S. are fearful right now, and they need lower rates to force them out to take on risk. And I think that will help, too, in terms of getting the securitization markets back going, which is a liquidity thing that we all need for not just mortgages, but for credit cards, for auto loans, for commercial loans. All of those have become securitization markets today. And that securitization market right now is shut for a lot of those types of products.
Isn't that because it's hard to tell what the default delinquencies are going to be on these Alt-A's that reset next year and the year after? Who's going to buy that until you have a good feel for that?
Well, I think, the mortgages that are being done today, we're back 20 years in terms of credit quality. These are the safest, cleanest mortgages since about October that you would want, other than home price, Ed, going down. So you want that. I agree with you on that aspect. So, and you're seeing the rating agencies in a panic. They're rating the deals where the AAA is a super AAA, the AA is really a AAA, and so on. So the ratings are all super conservative, and the spreads on where all the bonds are trading are at the widest levels ever. So ultimately, if we get interest rates low enough, investors are going to start to come back into those products. They'll watch the early delinquency trends on the new originations, and you'll see some of that marketplace come back.